Hey, it's Soleil, and this is episode 234 of the Orange Pill Investor. And today I want to talk about the cost of limited upside. So, I talk a lot of shit about collecting 1% a week and then, buying shares with the profits. And if everything goes well, then you end up with a bunch of money later. Not financial advice, but that has worked fairly consistently uh, with the mining stocks and with other stocks that are fairly volatile. Tesla is the one that I've been trading for as long as I can remember. Started trading options in May 2020. And back then I used to trade anything that no matter how risky it was, if it was premium, it was getting traded. And so that's worked pretty well. And but but MicroStrategy seems to be proving the exception to that rule. And I don't mean that it's not profitable. MicroStrategy, in my opinion, I did a video on this. I believe it's the strategy, or excuse me, it's the stock for every bullish strategy. So if you're on Investopedia.com or whatever, and it's a bullish strategy, in my opinion, the best stock for that strategy is going to be MicroStrategy. So even selling covered calls when I'm limiting my upside, covered call strategies might not be the best strategy for MicroStrategy, but MicroStrategy is going to be the best stock for covered calls because it's the best strategy. It's the best stock for every bullish strategy. So, but so at one point I decided to mock up what the potential road to $10,000 a share would look like, and that was pre-split. So I was just kind of lazy, and I really don't feel like dividing by zero and filling out the spreadsheet again. So just keep in mind that these are pre-split numbers, but I'm going to go over this again. And I thought, um, I talked to some people about the way that I trade, and some people have been, raised concerns about being nervous about selling covered calls, limiting their upside, and they'll just, if you're going to get a pit in your stomach because, um, you sold a covered call at 160 and it's at 180, and you missed out on 2 grand per 100 shares, that can definitely be an emotional, a bummer. So let's look at the potential cost of limited upside. This is all completely hypothetical. There's a lot of rounding here. This is just ballparking. And the basic assumptions are that the way that MicroStrategy pumped from 500 to 2000 is exactly the way that it will pump, you know, until it gets to 10,000 a share pre-split. So $1,000 a share at current prices. And the way that it pretty much went when it went from 500 to 2000 is it took about a month, and the first week it went up 50%, and then the second week it went up another approximately 50% again, and then it went up approximately about 40%, and then the last week kind of just got that last little oomph in there. But the crazy thing is that when the numbers get so big, even the 25% was more than the initial 50% pump, because it was 50% only made it go up $250 a share. But the last 25% was going up like 400 a share. And the way that I kind of modeled it out was, and so this was damn near probably 6 months ago at this point. But at that time, my basic assumptions were that it would follow this same pattern, and they would be roughly spaced out over the next year and a half. And this was back in like March or something. March, April, May, somewhere around that time frame. And so what if there are 4 of these events that are just like the one where it went from 500 to 2,000, which would be 50 to 200 in current prices, then, and assuming that it meets resistance and then, drops again. And that's exactly what happened. Is we went from 500 to 2,000, and then we hit 2,000 and it pulled back pretty sharply. I forget how long it took to get back down to 1,000. But in my scenario, I have that playing out. So it's basically 4xing to 2,000. Then it's kind of finding support at 1,000 and then 4xing again to 4,000, hitting resistance, finding support at 2, 4xing to 8, finding support at 4. And then at some point on this next pump, it hits 10,000 or 1,000 post split. If all of that happens, and so this is just one way that MicroStrategy could get to, basically what is $1,000 a share now, because you have to divide all these numbers by 10, cut a 0 off the end of them. Then there would be 4 of these events. And in the first one, if you're setting your covered calls at 20% call away value, then you're missing out on 30% of this 50% move. Same thing on this 50% move. Then you're getting a 40% move, so you're catching 20% and you're missing 20%. And on that last 25% move, you're catching almost the whole thing. You're catching 20% and you're missing out on 5. Now the good news here is, even though you're only catching most of this one move, this is kind of like the move is just as big as all the other ones, because this is a $250 move. This is what, approximately 400, another 400, and then another 400. So you are capturing most of at least one of the 4 big moves. But this is still huge. So instead of your account going up from $500 a share, let's just do 50 and 1,000. But you bought shares at 50 and it goes to 1,000, so you made $950 profit, and divide that by what you started with, and you basically 19x'd your money. But if you are only catching 20%, it's going to be 1.2 raised to the 4th power. You're going to basically double your money, but you do get a bonus here, because, and actually I forgot to calculate this part. So it's actually not going to be as bad as it seems, because then you're going to get 46%, because you're catching 1% a week, and 46 of the 78 weeks, maybe nothing happens. So, but you're going to collect that 1%. And so if you multiply this times 1.46, you're basically tripling your money, but that's a hell of a lot worse than 19xing your money. You are going to get a little bit of a bonus here, though, as well, because if you're buying 1% a week for 46 weeks, then these 46, let's just say you started out with 100 shares. Well, these extra 46 shares are going to get the full, these are not covered. You'd like, if you have 100 shares, you sell 1% premium, and then now you have 101 shares. Well, that one share is uncovered. So in that sense, 46% is getting 100% of the gains. And my brain is starting to melt a little bit. I don't know how to capture that. Let's see for a second. Well, okay, yeah, so 40.46 times the 19x is 8.47 plus the 3x that we already got. So that's not looking so bad. So the booby prize for not getting a 19x on profits would be getting an 11x. But at least, if all of this, if this exact scenario, excuse me, scenario plays out, then yes, selling covered calls would limit literally half of MicroStrategy's upside. And the numbers will be completely different if, it doesn't do this 4x in 4 weeks like what it did earlier this year. Maybe it just grinds all the way up. And in that scenario, selling covered calls would capture the majority of the upside. But I don't, I definitely don't see that happening. Now, there is one potential saving grace, and that is if the Q1 earnings is a binary event that triggers just a huge upside. Oh, might have to let my dog out. I will absolutely not be selling any covered calls over MicroStrategy earnings period, but certainly not the Q1 one when there's a reasonable expectation that they report fair market FASB rules. And I mean, hell, that could be a 50x over, I'm not sorry, 50x. That could be 50% move overnight. Like that could just be insane. So in that case, it would be, possible to strategically catch that move. But still, that's not selling covered calls mechanically necessarily like what I've been able to do in 99% of every other stock that I've ever traded. Um, so and I just did this math, but I think it proves that buying, one share a week per 100 is not going to cut it if you still want to make the 20x profits that MicroStrategy is capable of. And so what I had been doing over the last couple of months, um, I guess you could call it an accumulation phase, is I've been trying to stack enough long calls so that I have 50 unlimited delta, basically a 50 delta in long calls would approximately be the same upside as 50 uncovered shares. And I've been trying to keep that, 50 uncovered delta per 100 delta of covered calls. And that's to make sure that I'm getting exposed to a bunch of upside. So I think these long calls, I think it's reasonable to expect if you were able to just be completely disciplined with holding them. So if you're buying the 380 strikes today for December 19th, that's costing you $3,000 a pop. If, and I hate that this is right where I don't need it to be. All right. And the price goes to 1,023. Then in December at expiration, your $3,000 investment would sell for 64, meaning you basically 20x your money here. So the only way that I can see to compete with the covered call strategy is to use those premiums to stack long calls. So every dollar um, that's put into leverage looks like it would kind of even the playing field for the covered call strategy. And with a little bit of luck, because I just sold off like I had 80 of these, and I just sold off like 70 of them to free up some buying power ahead of MicroStrategy's earnings call. So I definitely won't be 10xing on these. I pretty much probably 2x'd. My trade price was 284, and I sold a bunch of these for just under 6, and some that were over 6. So probably averaged out to a nice, doubled up on all of these calls. But that is also a far cry from 20xing. And this is, and the timing is a little off on this too. So this is saying you can 20x from where we are now at 175 a share. But if these were purchased back when I formed a spreadsheet and MicroStrategy was 50 a share, that's like less than a third of this current price. So I'm assuming you could have gotten these for at least way less than a third of this, but let's just say $1,000, and now that's 60x. If you had these December 19th long calls 6 months ago, you're probably looking at 60x on returns. So I think that's the play. Is the only way with a stock as volatile as MicroStrategy, the only way to tweak the covered call strategy in a bullish market when it can just frickin' rip to the upside, insane, upside moves. The only way to keep up is to, instead of buying shares, buy long calls. And I got to repeat myself, not financial advice, because long calls are leveraged. They're extremely risky. And when the price goes up, it's all freaking, unicorns and rainbows. But the same leverage up is the same leverage and pain and suffering that you feel when it goes down. So when I started dollar cost averaging into these February long calls, my initial trade price was about $5. So $500 a contract. And the price was going down. I was probably buying those when MicroStrategy was 170. And so I just kept dollar cost averaging as the price just kept, finding lower lows and lower lows. And I was able to get my average trade price down to 284. But when I was dollar cost averaging this, the value on them was still only like $2 a contract times 100 since it's options. So this was looking pretty bleak at one point, and it was just gritting my teeth and just continuing to buy with every little bit of buying power that I was getting from selling these covered calls. So, long story short, I guess it's not a TLDR version if I give it at the end and you've already had to wait through the whole thing. But in this particular scenario, the cost of limiting upside, if you're just buying, a share a week per 100 shares, the upside would basically be half of profits. It doesn't mean that MicroStrategy will get to $1,000 a share in this way, and it doesn't even mean that it will get to $1,000 a share. Maybe it only gets to 300 or 400 or 500, and none of these catalysts really come to fruition, or there's a black swan event that randomly happens or is manufactured. And I'll probably do an entire video on this, but I'll briefly mention it. There was a phase that I went through when I scoured YouTube just looking for every single sailor interview that I could watch, and that was probably my orange pilling phase. That's when I kind of got laser eyed completely. And since then, and most recently, it's been Jeff Booth has been filling um, that criteria. And one of the things that he talks about is that he's pretty sure that Bitcoin will succeed. Um, and he likes to say, as long as it stays decentralized and secure, then Bitcoin wins. But if it fails to remain decentralized or secure, then it fails. And he said it's very, very, very unlikely. It's basically grown up past the point when it can be killed. But there are some, couple little small existential threats. And the whole point of saying that is that if you cannot attack the system that is repricing the world and taking away the current system's ability to prey upon us and steal our productivity, what those people in that control structure are extremely motivated and incentivized to co-opt Bitcoin into the corrupt system. And if they can't do it on layer one because Bitcoin has remained decentralized and secure, then they must do it on layer two. So they must co-opt, with shit coins. What are the Fed coins, or Tether, getting everybody to get into stable coins, and then that's the avenue that everybody has to use instead of dollars to get their hands on some Bitcoin. And in that way, there is some kind of way that they could get to layer one through layer two. And that was also a long ass winded way of saying that I think that MicroStrategy, the the potential for the system attacking Bitcoin, or being able to attack MicroStrategy, is, I don't know, 100 times easier than killing Bitcoin. Um, if firms like BlackRock start to hold giant sums of MicroStrategy on their balance sheets, then maybe they would be disincentivized to attack MicroStrategy. But I'm not privy to all the backroom meetings that these motherfuckers participate in. So I don't know what motivations they would potentially have to hurt MicroStrategy. But I just know it's going to be a buttload easier than attacking Bitcoin on the base layer. Um, and I know there's some, I guess, maxi squared folks that I've even seen uh, some tweets that said that they actually they actually hope that MSTR and holders get wrecked, like, just for having the audacity to own an asset that isn't Bitcoin. And I think that's kind of stupid and shitty. But the point is that they do have a point when they say that, not your keys, not your coins, and they're the risk of owning anything other than Bitcoin exposes you to what's not uh, what Bitcoin does is self custody. So you can, it's basically, as long as you hold it responsibly, then it can't be taken from you. And, you know, MicroStrategy becomes wealthier than most countries in the world. Would that be something that the U.S. government might want to seize? Like, I can't imagine that they wouldn't want to seize all of the Bitcoin on the exchanges, which is why you don't keep your frickin' Bitcoin on an exchange. But can they just confiscate MicroStrategy like they confiscated gold and then reprice it for themselves? Like MicroStrategy's worth $1,000 a share, and they confiscate it, but they only pay out each person 500 a share or 100 a share, and then they let it be repriced to 1,000 a share. Uh, that that just came to me off the top of my head, but I'm sure there's there aren't a whole lot of smart politicians, but there's sure as hell a lot of smart evil sons of bitches in the 3-letter agencies that could probably figure out some ways to wreck us, and and they have the ears of these idiots that are in charge. So that is an attack vector in and of its own, and which is why I don't necessarily feel like, okay, I'm going to hold MicroStrategy in the same way that I hold Bitcoin. Um, if MicroStrategy goes to $1,000 a share, I will absolutely be taking some profits, and I will be stacking sats with those profits. Um, the covered call premiums on $1,000 a share MicroStrategy is going to be pretty freaking legit too. So I am also looking forward to that. And then if the cycle continues, maybe can rinse and repeat, stack all the way down, stack leverage all the way down, and then sell. Um, I guess that would be a long vol play. You're buying long calls when it's cheap, and then hoping the volatility increases, and you can sell the calls more expensive later. I didn't even know what the hell long vol was until I started watching Chris Cole videos. So shout out to Quant Bros for even putting that name in my ear. But yeah, so the TLDR version of the TLDR version is the only way I think that covered calls will work with MicroStrategy to get similar or even bigger gains would be to stack all of that premium gained into long calls, and then have a little bit of luck with, you know, with maybe, on dips, not selling covered calls and short and selling myself short. Um, Maybe only sell covered calls after pumps, something like that, just being a little bit more strategic with it. But it does appear that mechanically selling covered calls at a certain, percent strike and just with no thought about the current price would probably limit about half of MicroStrategy's upside if it gets to $1,000 a share in this manner. So basically 4 pumps like what we had earlier this year, if that happens 3 more times, we'd pretty much get to 1,000 a share. So I just thought that was a good cautionary tale for anyone who has been following the strategy that I talk about and assuming that limited upside is no big deal because half losing half the potential gains on MicroStrategy is a pretty big fucking deal. So learning, things like this over time and just trying to be thoughtful and thinking about this has definitely made me alter my strategy from when I first started selling this, because when I first started selling it, I was just going to Market Chameleon and going to their implied volatility charts, sorting by highest implied volatility, and then any stock that was near the top, I was trading. And at some point, because I was a Bitcoiner, I, heard that MicroStrategy was a quote unquote levered Bitcoin play, and the premiums were freaking amazing. So it was my preferred stock to trade the covered call strategy against, and it was doing better than any other stock that I could find. And the upside was also the greatest. So it was just kind of win-win scenario. Um, you know, but it's not necessarily going to outperform buy and hold until the bear market starts, and then it's going to outperform like a motherfucker. Um, and so maybe that's the solution too. Is if you can figure out when the bull market starts and when the bear market starts, then you can sit on your hands and do nothing during the bull market, and you can load up on covered calls during the bear market, and maybe that's the answer. But I am kind of learning things as I go, and Bitcoin never existed before, so I think the entire human race is learning as we go with what Bitcoin means for the world and for the economy. And I think that's it. Probably talked way longer than I meant to, which is probably every freaking video. All right, be good, y'all.